Greetings, everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely visit the website at cubicleinvesting.com. All right, so today is actually a weekend. Decided that I would make a quick video just discussing. So today is February the 17th. Obviously, it's a weekend, Saturday. To discuss the this past week. Well, primarily the trade that I put on this past Friday, which was yesterday. And Friday was a really good day for myself and also for my Flip That Option members because it was a pretty easy trading day for those folks who understand and follow the Flip That Option trading steps, right, to increase your probability of essentially having a successful trade. If one adheres to the trading steps that I had come up with over the years. So on Friday, which was February the 16th, got my point here. So as we can see, so this here represents the price action for Friday, this past Friday, and as you can see, right out the gate, because of the producer price index number that came out on Friday, PPI, which is like it's analogous to it's similar to the CPI, the Consumer Price Index, but it's the inflation rate for the producers. So you got one for the consumers and one for the producers, and so both numbers actually came out higher than anticipated, and so the market reacted negatively. As you can see here, right out the gate on Friday, the SPX, which I primarily trade, right? So the SPX actually dropped significantly when the market opened on Friday, and it dropped right before the 10 o'clock hour on Friday. It dropped below my level where I was looking to put on a trade, and so when it dropped below 50.11, that was my cue to begin to look for look for a trade position. And so I decided, as I always do, to go on the put side, well, specifically to trade in the direction in which the SPX is moving. And so because it's moving down, I'm essentially looking to get on the put side, to put on a put credit spread, and to get below the floor. So as you can see here, the floor, at least at around 10 a.m. Eastern Standard Time, was roughly 49.99, around that area. So that was the floor. So I was just looking to use the energy that the SPX had used to drop rather significantly and rather quickly right out of the gate on Friday, to use its energy against it and essentially to trade in the direction. And so I went on the put side and I went to 49.55. And because the IV rank, or the volatility, was rather high on Friday, I was able to get so far away and still get a decent credit. So I was able to get a credit for $30. So I sold 10 contracts. So my goal on a daily basis is to make between $300 to $500 per day. Sometimes I make a little less, sometimes I make more. Right, so I'm just looking to take what the market gives me, and so I was able to go pretty far away. As you can see here, this wick stops at 49.99. I was at 49.55, as you can see here on the put side. Whereas some people would see this drop and would, think to go on the call side, because the call side, it benefits from the price of SPX actually going down. But I'm always afraid of what actually took place on Friday. I'm always afraid of exposing myself to that potential reverse and direction. As you can see here, it opened up at 50.31. It dropped down to as low as 49.99, and then it actually reversed and it went back higher later in the morning, and actually went above the opening price. And so Uh, that's the mistake. That's the mistake that a lot of traders make when they are trading, particularly vertical credit spreads. They are looking to trade in the opposite direction or to place their position in the opposite direction in which the SPX is moving. And again, had one placed there, their trade, let's say at 50 30, or 50, when I say trade, place their short position at 50 30, 50 35, because you saw the price of SPX going down, and you probably thought that it was going to stay down or potentially, at least stay below your short strike on the call side. For example, if you were at 50 30, but as you can see here, late in the morning, it actually reversed and went back up. So you probably would have been tested, obviously, or you would have been tested if you were at 50 30, depending on what time you put the trade on, and you would have either had to roll or just close out the position for a small loss. So this way, when you trade, from my perspective, when you trade in the direction in which the SPX is moving, you actually avoid the exposure of the reversing direction, and just having all of this information to the downside. It makes you informed as to where you need to place your money bag, well, not your money bag, but your short position and your long strike, to essentially get outside of the reach, or get beyond the reach of the SPX. And so what I do is I send out levels, 3 levels on the call side and put side, that are high probability positions where one can place their short strike and long strike to have a high probability of walking away with the money. And so I send those out to my flip that option members on a daily basis. And so the first level on the put side was actually, the third level on the put side was actually where I was on Friday. And so that third level is a level that's rarely breached by the SPX, just based upon some research that I have done, looking at 23 years worth of historical SPX data. That level 3 that I calculate on a daily basis, the SPX rarely goes beyond that level 3. So yeah, this is how I pretty much win the majority of my trades, just by waiting for the SPX to make a significant move with respect to the opening price, and 2, looking at the levels that I calculate every day and making sure that if possible, I can get beyond my level 3 and still get a relatively decent credit. And I'm always looking to trade uh, in the direction in which the SPX is moving. And so, and also because I'm only focusing primarily on the SPX, I'm really familiar with how the SPX moves, how it reacts to news, and essentially, the average range from the high price of the day to the low price of the day. I'm pretty much familiar with, what the average range is for the SPX, just based upon, looking at historical data. So, I pretty much turned the SPX into my own ATM to some degree, and that's what I help to, I help and assist others with trying to get get that same perspective with the SPX, and just showing them the power of focusing on one underlying, and how you can and how once you become very familiar and intimate with that underlying and how it moves, you can pretty much turn the market into your own ATM.